Why some people build substantial wealth over time through smart investing, while others, even smart ones, end up struggling financially. The truth is, it's often not about finding the perfect stock or timing the market perfectly. It's about avoiding simple, repeatable errors that quietly erode your progress. Today, we're going to walk through 7 common mistakes that many beginner investors in the U.S. make, and more importantly, how you can steer clear of them to set yourself up for long-term success. Welcome back to the channel, where we focus on practical, straightforward personal finance and investing advice tailored for beginners here in the United States. If you're just starting out with things like 401ks, Roth IRAs, or brokerage accounts, this video is for you. We'll use real-world examples, simple explanations, and US-based scenarios to make everything clear. Think about this. The stock market, through broad indexes like the S&P 500, has historically delivered around 10% average annual returns over long periods, including dividends. That's powerful when combined with consistent habits. But many people miss out because of avoidable pitfalls. Have you ever bought into a hot trend only to see it fade, or felt the urge to sell during a market dip? These are the kinds of things we'll cover. By the end, you'll have actionable steps to build a stronger foundation for your financial future. Let's dive in. Mistake number 1, relying only on personal experience instead of learning from history. One of the biggest advantages we have as investors today is access to centuries of financial history. Yet many beginners focus solely on their own trials and errors, which can be costly and time-consuming. Consider this. Why go through every potential setback yourself when you can study what others have already encountered? Historical events like the dot-com bubble in the early 2000s or the 2008 financial crisis show recurring patterns. Overenthusiasm leading to inflated prices, followed by corrections. For instance, during the housing boom in the mid-2000s, many Americans borrowed heavily to invest in real estate or related stocks, assuming prices would keep rising forever. When the bubble burst, margin calls and losses wiped out portfolios. The lesson? Borrowing to invest amplifies risks dramatically. The same themes appear in earlier events, like the 1929 crash, or even older market manias. Patterns of greed, fear, and ignoring warning signs repeat. What if instead you dedicated time to understanding these past events? Reading about companies that seemed unstoppable but collapsed. Think of the failures in the internet sector around 2000, where billions in market value vanished, can help you spot similar signs today. Or look at hedge funds that used complex models in the late 1990s, promising low risk but ultimately facing massive losses. Even experts can overlook flaws in their strategies. A practical step for beginners: commit to exploring one major financial case study each month. Books, documentaries, or reliable articles on events like the 2008 crisis or Enron's collapse can provide insights without the personal financial pain. This approach compresses decades of lessons into a short time, helping you make more informed decisions in your own portfolio. Ask yourself, am I learning broadly from history or just reacting to my recent wins and losses? Transition. That foundation of knowledge leads naturally to our next common error.
Mistake 2 is investing in things you don't fully understand. This one is straightforward but powerful. If you can't explain an investment simply, it's probably not the right fit for you, at least not yet. Many beginners get drawn into complex or trendy options without grasping the basics. For example, during the cryptocurrency boom a few years ago, countless people in the US poured money into digital assets because of exciting stories online, but without understanding concepts like blockchain validation or token economics. The result? When prices dropped sharply, confusion turned into regret. Contrast that with everyday products. You might spend time researching a new appliance, comparing features and reviews. Why not apply the same care to investments that could impact your retirement savings? A good rule for beginners: stick to what you can describe clearly. Take a company like a major beverage maker. People buy their products daily, generating consistent revenue, which can lead to profits shared with shareholders. That's easier to follow than intricate financial instruments. Even missing some big winners is okay if it means avoiding big losses. Many experienced investors passed on early opportunities in fast-growing tech because the business models weren't clear at the time. They prioritized preservation over chasing unknowns. Test your current holdings. Can you explain in a sentence or two how the investment generates money, not just why its price might rise, but the underlying business? If it's complicated, involving layers of derivatives or unproven tech, consider simplifying. For U.S. beginners, starting with broad index funds tracking the S&P 500 can be ideal. They give exposure to hundreds of established companies without needing deep knowledge of each one. Understanding your investments builds confidence, which helps with the next challenge many face. Mistake 3, trying to build wealth too quickly. Patience is one of the most underrated aspects of investing, especially for beginners. We all want financial security sooner than later, paying off student loans, buying a home, or retiring comfortably. But rushing often leads to unnecessary risks. The real driver of growth isn't dramatic short-term gains, it's consistent compounding over time. Historical data shows the S&P 500 has averaged about 10% annually over decades, turning modest regular contributions into significant amounts. Let's look at some numbers to illustrate. Suppose you invest $10,000 each year in a low-cost index fund, aiming for that historical average. After 30 years, with around 10% annual returns, that could grow to over $1.8 million. Note, past performance isn't a guarantee, and returns can vary. But if you're chasing higher returns through frequent trading or speculative picks, fees, taxes, and mistakes can eat into progress. Many beginners see stories of quick wins, like meme stocks surging temporarily, and feel pressured to act. Yet those often reverse, leaving holders with losses. Instead, focus on steady habits. Regular contributions to tax-advantaged accounts like a Roth IRA or 401k, especially with employer matches. The key is time in the market, not timing the market. Boring? Maybe. Effective? Absolutely. Question for you, are you giving your investments enough time to grow, or are you jumping between strategies? That long-term mindset ties into how we spread risk.
Mistake 5. Overlooking fees and taxes. Small ongoing costs can add up dramatically over time, quietly reducing your growth. Expense ratios, trading commissions, and tax implications might seem minor individually, but they compound, just like returns. For example, contributing $10,000 annually for 30 years at 10% gross return. In a very low-cost fund, around 0.04% fees, it could reach about $1.8 million. In a higher fee option, 1% annually, the net return drops, ending closer to $1.5 million, a difference of over $300,000. That's money that could have stayed in your account. Active trading triggers short-term capital gains taxes up to ordinary income rates, plus commissions. Long-term holding in tax-efficient vehicles like index funds in a Roth IRA minimizes this drag. Many successful long-term approaches avoid frequent sales to defer taxes, letting money grow uninterrupted. Action step. Check your statements for total fees paid last year. If it's more than a tiny fraction of your balance, look for lower-cost alternatives. Platforms like Vanguard or Fidelity offer excellent low-fee index options for U.S. investors. Transition. Minimizing costs keeps more money working for you, but even the best plan can falter if... Mistake 6. Letting emotions drive decisions. The market doesn't always feel rational, and neither do our reactions to it. Fear during downturns prompts selling low. Excitement during upswings leads to buying high. Look at March 2020. The rapid drop amid uncertainty caused many to exit positions, locking in losses. Those who stayed invested saw a strong recovery within months. Then, as prices climbed, new enthusiasm drew in buyers at peaks. Emotions evolved for immediate threats, not long-term charts. To counter this, create a written plan when calm. Rules like only sell if I need the cash for essentials, or rebalance annually, not react daily. Stick to it during volatility. Tools like automatic contributions remove daily decisions. Building wealth is often about discipline over drama. Transition. Staying disciplined through ups and downs is crucial because the final mistake is mistake 7, giving up before compounding fully kicks in. This might be the most common reason people don't reach their potential. Growth starts slow. Early years feel underwhelming, small balances fluctuating. Many stop after 5 to 10 years, frustrated, missing the acceleration. Compounding shines later. Returns on returns build momentum. Sticking with consistent index investing for 30-plus years has historically positioned people well, even through challenges. Don't switch strategies frequently chasing better short-term results. Choose a simple, proven approach, like low-cost S&P 500 funds, and commit long-term. You'll face temptations, crashes testing resolve, friends sharing quick wins, but persistence pays. If you've stayed consistent so far, you're ahead. Keep going. Avoiding these 7 mistakes, learning from history, understanding your investments, being patient, diversifying wisely, watching costs, controlling emotions, and not quitting can make a profound difference. This isn't about guarantees. Markets fluctuate and individual results vary, but focusing on these principles has helped many American investors build security over time. Remember, this is educational content. Consider consulting a financial advisor for your situation. If this resonated, give the video a thumbs up, share it with someone starting their journey, and subscribe for more calm, practical advice on personal finance, index fund investing, compound growth, and beginner strategies. Turn on notifications so you don't miss the next one. What mistake do you see most among beginners? Comment below. I read them all. Thanks for watching. Start small, stay consistent, and build steadily. See you in the next video.